Welcome back, guys, to my channel. That is Auction Market RS. Hope you guys know me. My name is Rohit Sawant, and I believe like you people are enjoying the contents for the auction market, as this is a very new concept in Indian uh, subcontinent. Uh, yeah, so let's move ahead with today's topic, that is open interest types. Like how many types of open interest we have, uh, options open interest, future open interest we have, change in open interest and change in price we have, and there is something called as long build up, long unwinding, short build up and short covering. So these are the basic requirement uh, which we need to understand before entering into the market. Without this, it is very difficult to analyze the trend of the market, the price action behavior, and who is trying to dominate the market. Okay, so let us move ahead to the next slide. Okay, so open interest types. So there are basically two types of open interest. So we have something called as FNO, okay, future and options. So one is open interest and the second one is future open interest. So there might be some difference between these two, right? Both cannot be same. Okay, so we'll start with the first option. Options. What are options open interest? An option open interest is created. Okay, I'll just try to explain this slide and then I'll try to elaborate it. So when buyers and sellers meet and that particular contract closes, one open interest token is being generated, okay, in every market. So that each and every token is tracked under some option, we call it as NSE options, NSE option chart. Okay, there each and every position is been maintained. Whenever a buyer and a seller contract, completes, one particular token is created or one particular open interest is created and added to the account. Okay, however, in the case of options, we defined open interest from the seller point of view. What exactly this means? So guys, whenever we try to buy any options, they are very less expensive. Okay, and whenever we try to sell any options, they are more expensive. Uh, so why option seller have to pay a huge amount to buy a single lot, where one single lot you can buy of any option of any strike, okay, ATM or OTM, within 5 to 15,000, okay, within of 5 to 10K, depending on the that particular strike, or depending on the price for that particular time, the price may vary. Okay, but why that particular option, when we try, when we want to sell that particular option, why we have to pay in lakhs, 1.5 lakhs or 2 lakhs for a single lot? Okay, just take an example. Option seller have more advantage compared to option buyers. Okay, he controls the market. So take an example, an insurance company trying to sell their product. And what is the insurance product? They're trying to sell their insurance to particular organization. Take an example, health sector. Health insurance company try to sell the health insurances. But how many people try to, utilize that particular insurance? How many people, get sick and, get hospitalized? Okay. There are very less number of people who get hospitalized or who utilizes that particular insurance. So in that case, who is getting benefited over here? Definitely the option sellers, not the option buyers. Option buyers are trying to uh, pay the premium to option sellers. So definitely, guys, option sellers are taking the premium and they will earn a lot. That's the reason option seller premium to buy one lot is very expensive compared to option buying. Hope you guys are with me. I'll move ahead to the next slide. So here, this is an option chart, okay? So we can try to plot the support and resistance. So take an example, if somebody wants to buy something, okay, Nifty 50 stocks or Nifty index, okay, if he wants to buy, he has to opt for a CE call, okay, but when it in terms of option selling, okay, he will sell that particular option. When the price goes up, option seller will earn the money over there. Then in that case, he will try to sell that particular option. So the arrow, you can see it over here, okay. So 24,000 will be acting as a strong support, okay, to buy any position. When particular strike price goes up, okay, from 24,000 it goes to 24,250, 350, then option seller tries to sell that particular quantity in PE, okay, he will try to sell that particular quantity in PE. So that's the reason 24,000 is a strong support over there. Why it's a strong support? You can see the open interest is 3.7 millions and OI change is 1.5 million. That is the very highest over there. So that's the reason we have marked it as a support. Okay, we have also another support where you can see 3.4 million and 1.1 million. Okay, even this will act as a support. If this particular support breaks, then the next support is 24,000. Okay, and in the left hand side you see a resistance. So what exactly is resistance? 4.8 million open interest change. So sellers will not allow the price to move above 25,000. Okay, so the price will fluctuate between 24,000 and 25,000. So these two are strong support and resistance. Okay, as option seller, he will always try to sell the P when the market moves up. Okay, that's what I explained in the spot chart. When spot goes up, we will try to sell that particular option. Okay, that's how option seller maintain or gains the consistent profit compared to option buyers. Okay, so guys, I'll move to the next slide. Okay, so what a future open interest is? Okay, in case of future, both buyers and sellers are dominant, but in case of options, both buyers or seller are not dominant. Sellers are dominant over there, not the buyers. But in case of futures, both option both option buyer and seller, both are dominant in case of future. Okay. However, we go ahead with their strong to move up the price. So if the price is going up, whoever is driving that particular price, he is a winner over there. If the price is coming down, the seller is winner over there. If the price is going up, the buyer is winner over there. Okay, we'll move to the next chart. So this is a very basic concept, but I have seen like people are not aware about this. So you people might have watched couple of news channel where they come up and saying that long buildup is happening, short buildup is happening, long unwinding is happening, short covering. So short covering, I think you guys have heard a lot in the news analysis, or some YouTube channel is going on there. People are telling like short covering is happening, long buildup is happening. But what exactly is long buildup, short buildup, long unwinding, short covering? Okay, so we'll try to explain it here. Long buildup, okay, when buyers are dominating the market, the open interest increases. As I've already told, when a buyer and a seller contracts completes, one particular token is generated and that token is called an open interest. Okay, so when a buyer is dominating the market, when the buyer is pushing the market upside, one particular contract is closed and that contract is called a open interest contract, and that particular contract will increase by one. Okay, and the price also increases along with the spot. When buyers are dominating the market, the open interest will increase and the price also increases. Okay, so that means some smart money players are trying to create a hype in the market, or they are trying to push the market upside. And when new buyers come into picture, that's how we create an open interest and try to increase that open interest whenever the contract get closes. This is how we add on to the open interest. Okay, long wind up is clear. We'll go with the short build up. Okay, long build up, short build up is exactly opposite of long build up. Okay, in short build up, smart players or any instituted players are trying to sell that particular market positions. So in this case, what happens? Open interest will increase because the price is going down. And when the price goes down, that particular contract closes. And when that particular contract closes, one open interest token is generated. And because of that token generated, the open interest price will increase. But in actual spot chart, that particular price has to decrease. Why? Because people are shorting over there. They're trying to create a short position. So when you try to create a short position, people are trying to sell that particular instrument, and that price will go down accordingly. That's where the contract get closes and one open interest token is generated and it is added on. So here the price goes down and open interest goes up. Okay, I will move it to the next slide. Long wind up. Okay, so long wind up, it is exactly opposite of long covering. Okay, so traders who went long already in the position, now they are trying to square off their position. Okay, so they're trying to book some profits over there. Okay, you can consider it like this. So in this case, we have observed long unwind up, open interest decreases and price also decreases. Why open interest decreases? Because we are trying to close that particular position. We are not building a position over here. We are trying to close that particular position. So that particular token, we have to minus it from the option. And when we try to close the position, we try to sell it. And that's the reason the price goes down whenever you sell that particular position. Okay, so the number of contracts will reduce, and then the trader who went long, he has to close the position, so the price will come down. Okay guys, so this is a bit tricky one. So if you uh, rewind this concept like one or two times, it will benefit you guys to understand the concept clearly. But if you are facing any difficulty, please do comment. I will try to respond over there. Okay, so similar like long unwinding, we have two scenarios. Why people do long unwinding? When somebody is purchasing anything, he has to book his position, he has to book the profits. Okay, long traders are trying to unwind their positions when they are booking their profits. This is one of the case. Okay, the second case is like somebody is gone long, but unfortunately the price came down. Suppose, take an example, I bought a share for 100 rupees and now that particular share is trading at 98 rupees. So I am at a loss of 2 rupees. So in that case also, long unwinding takes place and I will try to close my position. Okay, let's go to the next topic. Short covering. Short covering is exactly opposite of short build-up. Okay, traders who went short in the positions are now trying to book their positions. Okay, so in this case, what happens? Open interest will decrease. Why? Because we are closing that particular position, and price will increase. Why? Because if somebody is trying to sell that position, to whom we will sell? To one particular buyer. So if buyer is purchasing that particular position, so the price will increase. Okay, short unwinding. So there are two cases of short unwinding. Similar to long unwinding, we have short unwinding also. So the traders who went short, they're trying to book their positions. Okay, they're trying to book their profits, or they're trying to book their positions for that particular respective price. Okay, short traders are forced to close their position as they are in the loss. So this is the second scenario. I went short at 100 rupees and now the price is trailing at 102 rupees. So I am forced to close my position by taking a 2 rupees loss. Okay, I'll move to the next slide. Okay guys, I think this is what I have for today. The basic option concepts, which will help us to understand the market fundamentals, the price fundamentals, where exactly the price action is going. Okay, please do subscribe, share, like and comment. Okay, if you have any doubts, reach out to me in the comment section. I will try to clear it there itself. And my channel handle is @auction market rs. Okay, thank you guys. Hope you liked this video. Please show your love for this particular video as well as you have shown for the previous one. Okay, thank you guys. Bye bye.